Hello, this is Dave Swenson, Department of Economics at Iowa State University. This is part 2 of our Introduction to Economic Impact Assessment for Local Foods. Now, in this section, we're going to start analyzing scenarios. And as you can see, I have something up there called Dave's Pretty Good Impact Model for Local Foods. That's a spreadsheet-based model for impact analysis. It's an input-output model that we're going to use, and the reason I'm using a spreadsheet is because it's easier to teach students how to use the model, how to interpret the findings, and how to work your way around a scenario. So this is an introduction to the process of economic impact analysis. Before we get started, we have some resources available for you. I worked on, with many of my colleagues, a toolkit for local foods economic impact analysis. And I recommend that you look at that toolkit. It's easy to access. There's the address. This is a USDA publication, The Local Economics of Local Food Systems, a Guide to Community Discussions, Assessment, and Choices. So this is a very, very important resource for understanding and learning how to frame local foods economic analysis projects. This toolkit is composed of several modules. Module 1, Framing Your Community Economic Assessment Process. Module 2, Using Secondary Data, learning where to find and how to use secondary data. Module 3, Generating and Using Primary Data. Primary data are when you survey something directly or when you ask somebody for information specifically. Module 4, engaging your community process with data, starting to use information with regard to your local foods project. Module 5 now gets into the economic impact analysis part of what we're trying to teach here in these sessions, analyzing linkages and contributions of local foods to local economies through input-output analysis. That's what we're starting on right here. That's what we worked on in these chapters. Module 6, we're addressing something called opportunity cost and analyzing economic impacts. This is the situation, again, that we're going to cover in this next session, where if you take land from a farmer to do something, and what you do is not do something that you used to do, we have to calculate the difference in the productivity associated with it. So if I'm now producing fruits and vegetables on land that was previously producing wheat or soybeans, I have to calculate the difference in economic outcomes given those two uses. And then finally, Module 7 has advanced in-plan analysis. In-plan is a type of modeling system that we used in this toolkit for demonstration purposes, and there are some advanced characteristics and advanced concerns, and so that's what Module 7 covers. The model that I've built for this exercise, that's a spreadsheet-based model, it was derived from the core data of a state of Iowa in-plan data set. So I'm using that very same modeling systems data to build this demonstration project. Also, and this is just as an aside, I have instructional videos on community economic topics, especially videos that cover understanding a little bit more about economic impact analysis. I have a short video on input-output logic and mathematics, things that I introduced in the last session, but I didn't go too in detail. If you want to know more about that, I have a video there. If you want to learn more about using different kinds of modeling approaches, for example, using the RIMS-2 multipliers that are supplied by the Bureau of Economic Analysis. RIMS-2 means Regional Economic Modeling Systems, or Regional Impact Modeling Systems. And we can use those multipliers as well to calculate regional or statewide economic impacts. And then there are other topics as well. So you can go to this link if you're interested in learning a little bit more about regional economics methods and community economics methods. Now we're switching to actually using an input-output model, and there are going to be some terms and procedures and processes that we're going to have to learn. We're going to learn in a series of how-to demonstrations. We're going to learn how to specify an economic change scenario using the model, how to interpret the results, how to differentiate an economic contribution, which I introduced in the last session, from a true economic impact. How do we measure the size of something in an economy versus how do we measure an increment to gain or an increment to loss in economic productivity? And finally, how to piece together an analysis using a statement of annual costs. And this is what we do in a situation where we have an atypical kind of scenario. And what we want to do is calculate the economic impacts by figuring out what were all of the inputs into production. During this session, I'll bounce back and forth between the slides that I'm showing right here and actually demonstrating these examples using my Excel-based input-output model. Again, the model will produce the same results as the in-plan model, the model that was used for the toolkit, but I've simplified the whole process for instruction purposes. We're also going to learn some new terms and considerations as we move along, so try to pay attention. I'll try not to talk too fast, and I'll try not to move too fast. So first, we're going to get familiar with this spreadsheet model. And the first part of this is just simply understanding how the spreadsheet model works. Next, on number 2, and I'm going to come back to this slide in a little bit, we're going to compare different outcomes from sets of industries so that we understand how different industries affect an economy and that we get differential results. So first, we're going to turn to the model right now. Here's the spreadsheet model that I've built for this exercise. I've used this type of modeling system in several different workshops, and it works pretty well for instruction purposes. Basic Excel spreadsheet, and the only thing you really need to know about this model is that we enter data either in this cell because there's an output change, or we enter data in this cell because there's some kind of employment change in these industries that I have aggregated along the side here. And we have several agricultural sectors, we have mining sectors, utility, construction, we have some food manufacturing sectors here, other non-durable manufacturing, durable manufacturing, wholesale, retail categories, transportation categories, warehouse and storage, publishing, movies and broadcast, telecommunications, data processing and other, banking, insurance carriers and brokers. We're going to scroll down a little bit more. Real estate, business services, legal services, accounting services. These are the business and accounting services categories. Healthcare and social services, arts, entertainment and recreation, accommodations, dining and drinking. Those are those services that mostly are consumed by households. And then we have governments, households, low income, middle income, and upper income. And we're going to use all of this as we work our way through this model. Now, there's one more thing to this model I want to point out. Remember I talked about that nifty formula, that Leontief transformation. This model, actually, you can click on this cell and you can see all of the parts that I used for building the model that we're going to use. So if you're interested in reverse engineering it, you're welcome to go ahead and look at this and see what I did. And you can see all of the different parts that I went through to build this model so that we could have sets of multipliers that we can use for our analysis. So I'm going to go back to the top here. We're going to click on where it says Enter Impacts Here, and we're going to begin our modeling process. When I start this kind of modeling instruction, what I want folks to understand is how different sectors react differently. So I always start with the construction sector, and I use that because it was so important during the recovery, during the Great Recession. Now, there's one thing I want you to pay attention to here. Everything that we're putting into has to be entered in millions. So I'm going to enter, in this exercise, $100 million worth of output change in my economy. So imagine that we got federal money to rebuild part of our economy or to stimulate part of our economy, and we got $100 million worth of funds that were to be used primarily, let's say, for road construction or school construction or repair and maintenance. So we're going to put $100 million into that economy. And then you can see things start happening in my model, but we're not really going to pay attention to what's up here. What we're going to do is we're going to go down over here to model results. And we're going to click on that tab, and it's going to give me the economic impact summary of what we just entered into the model. This direct shock of $100 million to construction is going to be reflected then in the model results. So here I have the model results, and you're going to see the effects of what I just did. I put $100 million worth of direct industrial output in the construction sector, I entered it into the Iowa economy. When I did that, it created 587 jobs to fulfill that construction activity. Those job holders were paid almost $32 million worth of labor income. And in total, directly, it stimulated almost $40 million worth of value added. Remembering labor income is a subset of value added. Now, I've combined the indirect and the induced activities into just one category. Sometimes we can separate out the indirect and induced, remembering that the indirect are the inputs into production, into the construction activity. The induced activity is what happens when households spend their incomes that they make from working. I've just combined the two here. So here we have the direct output of $100 million. Indirectly and through induction, it stimulated another almost $70 million in economic activity for a total of $169.65 million worth of economic activity. Again, the total divided by the direct gives us our multiplier. It's a type total or a type 2 multiplier. We get estimates of value added, again. We get estimates of labor income, and again, they have multipliers. And then we have estimates of job impacts. We had 587 direct jobs. We had 571 indirect and induced jobs for a total of 1,159 jobs and a jobs multiplier of 1.97. These are very high multipliers, and you can see why things like construction, especially during a recession and recovery, why they're so important to the economy is because they stimulate so many jobs per $1 million worth of spending. I also have additional information on the summary sheet here. It tells us the amount of labor income generated per job or value added per job in the direct sector, in the indirect sector, and in total. So you can see that these are reasonably well-paying jobs in the construction industry, that the indirect and induced jobs pay less, and when we add up all of the job impacts, the jobs still are reasonably good jobs on average, paying nearly $47,000 a year in wages, salaries, and benefits, remembering always that labor income includes wages, salaries, and benefits. Below on the model, we can see where the impacts accrued. You can see that most of the impacts accrued down here in the construction sector, and I'll go down. And then we can see other high categories of impacts in several of the other areas. In retail activity, because that's where workers spend their paychecks. You're going to see activity in insurance industry and banking. You're going to see activity in legal services and healthcare. You're going to see lots of activity in those areas. So you can see how the economy in this model is stimulated after all of these multipliers work their way through the economy. Okay, we're going to go back to our model here, and we're going to do something different. We're going to delete this here, and then we're going to compare a couple of sectors in the ag economy. So I'm going to put $10 million in oilseed and grain crops. I'm going to put a 10. And let's say that $10 million reflects the total amount of output in a small region. But we're going to put $10 million worth of sales, or $10 million worth of outputs. And then we're going to go straight to the model results. And again, for $10 million worth of output in grain and oilseed production in my state of Iowa right now, where this is a state level model, you can see what accumulates to the regional economy. It supports 12 jobs at the farm level. It supports another 40.3 jobs at the supply level and at the household supply level as well. So you can see that grain farming has really strong linkages in Iowa to the supplying sectors. Grain farming requires lots of supplies, and those supplies require a reasonably high amount of labor. And you can see that the multipliers are much higher, especially on the job side. Well, on the job side, there's very few jobs associated with $10 million worth of output in agriculture, in grain and oilseed farming in the state of Iowa. So that yields us a very high multiplier right here. And so you can also see the summary characteristics associated with that kind of farming. In the year of this model, $10 million worth of output would have also been associated with the labor income primarily to the farmer of almost $114,000 and value added of nearly $300,000. And then you can also see the labor income per job and the value added that accumulates to the rest of the economy, the indirect and induced parts of the economy, and the overall average given this scenario. Now just remember some of these numbers, that there were 12 jobs in the direct sector and 53 jobs total. I've now gone back to ag sector again, and I'm going to delete that, and here's what I'm going to do. I'm going to put 5 million in vegetable and melon farming, and I'm going to put another 5 million in fruit farming. So I'm going to have the same amount of agricultural output. We're going to pretend that we're doing this agricultural activity on the same land, or some fraction of the land that we were previously using for ag and oilseed grain and crops. So on the same land that we were using for grain and oilseed crop production. Now let's look at the model results. First of all, the number of jobs is much higher, much higher. Almost 58 jobs are assumed per $10 million worth of output in those sectors. And reasonably good multiplier, total jobs created are about 99.5. And so you can see both on a job creation basis and on a labor income creation basis, we get a higher economic impact comparing $10 million worth of output in these sectors, vegetables, melons, and fruits, versus doing the same kind of economic activity or measuring the same amount of economic activity in grain and oilseed production. So what I'm demonstrating here is that there are very, very strong differences between our agricultural sectors and our other industrial sectors, given the same amount of output. Okay, next what we're going to do is we're going to shock a sector in manufacturing. And the sector we're going to shock is food and kindred manufacturing. We can imagine a processing facility for grain products. Let's say it makes flour or it makes cornflakes, something like that in this sector. So what we're going to do, let's do this. We're going to add, again, we'll just use $100 million worth of output in food and kindred processing. We're going to enter that into the model, and then we're going to go to the model results. And we're going to see right off the bat $100 million worth of output in food processing in the state of Iowa. Food and kindred processing in Iowa doesn't generate very many jobs. 86 at the factory. These are very, very productive operations. Remember, back with the construction with $100 million worth of impact, direct impact, the job creation was in the 500s. Here it's just 86. We can see, though, that the industry has really, really strong indirect and induced consequences. What it does is it has way more jobs in the supply sector and in the household supply sector, in the induced part of it. And so it has a very, very high multiplier. It has a very, very high income multiplier. Well, there's a problem with this, and here's the problem with this. When we told the model that we were putting in a factory, or we were adding production to a food and kindred products factory, it assumed that we were going to generate more agricultural activity. But the point is this: the agricultural activity would have already existed in my economy, or I wouldn't have put the factory there. You don't build it and then they'll come, or build it and then they'll farm. You build it because the economic activity was already there. The farm supply was already there. So one of our problems with working with value-added agriculture categories, whether it's food and kindred products or whether it's animal slaughtering and processing, that the modeling assumes that you're creating upstream agricultural activity. And so when we shock that sector, we are taking credit for activity that already exists in the economy. So we have to be careful when we interpret the results and tell somebody, let's say at a Chamber of Commerce, that if I get a new food processing factory that has $100 million worth of output a year, it's going to create 453 jobs in my regional economy. Well, the answer is no, it's not. because a lot of those jobs had already been created in the farm sector, and then as the farm sector multiplies through, again, which I just showed you in the grain and oilseed category, that it had a very, very strong linkage to its upstream suppliers. And you can see how these multipliers iterate and can skew the results if we don't specify the model properly. So how do we fix this? Well, we fix this by offsetting or taking away the gains that would have accumulated to the supply sector, primarily the agriculture sector. And so what we do when we do this kind of modeling, we either flip a switch inside the in-plan model, or we enter in offsets in the modeling process so that we don't end up double counting economic activity that was already here. Okay, next we're going to have a very brief lesson with regard to wholesale and retail activity. Wholesale and retail activity in our modeling systems are treated differently than all of the other industries. In wholesale and retail activity, we do something that's called margining. And here's what it means. In wholesale and in retail, the wholesaler or the retailer does nothing but convey a commodity to somebody else. And so it does not add value, for example, to the lawnmower that the retailer or the wholesaler ships to the retail hardware store for sale. They don't add any value to it. The only value they add to it in general is their costs, their overhead costs of labor, building, utilities, display, and making it available for you to purchase. So because they add no more value to the commodity, we don't enter in the cash register amount of a wholesale transaction or a retail transaction. We enter in what's called the margin amount. And the margin amount simply excludes all of the costs of the goods sold. Now, the typical margins for wholesale is 15% or so. So that means if I had a wholesale purchase of $100, only $15 of that reflects the wholesaler's margin. So if I was modeling that, I would only enter in $15. In the retail sectors, the margins may range from about 18 to about 30%, depending on the industry. So we would enter, again, a retail automobile, let's say, that cost $80,000. If it was a 20% margin, we would only enter in the retailer's, the automobile dealer's margin. Same thing with food. If there was $1 million worth of food sales at the grocery store from a retailer, if we were measuring that industry or that sector of the economy and the margin again was 20% or 18%, we would put in $180,000 or $200,000 as the amount that reflected my retail margin. So that's what we have to always remember when we're doing retail. You cannot put in the cash register amount. You have to put in the retail margin, and the retail margin is typically between about 15% and 25%. For most instructional purposes, I have a retail margin of 20% that I work with. Okay, we're going to go back to the spreadsheet now, and we're going to do a scenario where we want to calculate the economic contribution of the fruits, melons, and vegetable industry in a state. So I have this Iowa SAM that I've been working from with this model, and according to that social account matrix, there was $8.89 million of vegetable and melon output and $15.69 million of fruit output in those sectors in 2015. So what we're going to do, we're going to put that information into the spreadsheet. Now, returning to the spreadsheet, we're going to put in ag, vegetable, and melon farming. We're going to put in 8.89 million, 8.89 million, remembering that these values are always in millions. And we're going to put in 15.69 million in the fruit farming sector of the economy. And then we're going to be able to go to the model results, and we're going to be able to say exactly what does that entire industry contribute to the state's economy. So combine those two agricultural sectors, explain an estimated $158 jobs, and jobs are expressed on an annualized basis, not the number of people who might work there over the course of a summer, but the number of jobs there would be if these people worked continually on that farm the way that kind of farming requires labor. So it's an annualized value of persons. So we don't want to confuse somebody hiring 5 teenagers to work on their farm for a couple of weeks with 5 jobs. So we had this initial shock or initial value. Remember, we're measuring the economic contribution of this industry, and it tells you what the expected amounts to be generated in that industry are. We have the indirect and induced values. Those are the values that are associated with the supply sector and the values that are associated with the workers in the supply sector and on the farms converting their paychecks or their proprietors' incomes into household spending. And then we get a total value for that sector in the state of Iowa. In total, that sector supports about 260 jobs, accounts for about 37.4 million in total industrial output in the state, 28.8 million in value added, of which 17.5 million is labor income. Again, to 260 workers. And then you can see the multipliers that would be associated with those sectors in the Iowa economy. So this is an example of an economic contribution analysis versus an economic impact. An economic impact would be that we were measuring an increase of some amount of production in either one of those sectors due to either expansion in acres or expansion in demand, but some sort of combination of economic activity that made that sector bigger. Here we're not measuring whether the sector is bigger, we're just simply measuring the size of the sector to describe how much it contributes to the state's total economy. Remember, we're talking now about the economic footprint of this sector, and we're able to tell somebody, or stakeholders, or policymakers, or farm interests, what the size of the fruit and vegetable production operations in the state, what the values are. Now, we have one issue here, though, and it's just a very minor problem in this, and there's a little bit of double counting in that the way that we're doing this, all of those job holders demand more fruit and vegetables, and so we end up creating a sector slightly larger than it really is, and so we might have to modify the model just a little bit. I have an example here of me doing it for another project, and it basically said the error rate was 0.3%. The point is, it's not much error, but it's an error nonetheless, and we have mechanisms for offsetting that. Okay, we have a new production example, and we're going to replicate some work that I did for the Leopold Center and for the state of Iowa back in 2010 with some updated numbers. Now, what we're going to do is we're going to imagine we have a new opportunity for production to meet seasonal fresh fruit and vegetable consumption by Iowa residents, and these Iowa residents in this model were metropolitan Iowa residents, people that live in larger cities. And we're going to estimate the economic impact of that assumption. We're going to meet some fraction of their demand. What we measured in that model was between 25 and 50% of their seasonal demand for a bundle of fruits and vegetables. But we're also going to calculate a countervailing consequence, the opportunity cost, because all of the new land for this scenario is coming from existing grain farming. So we have to start out with, this was the bundle of vegetables and fruits and melons that were in our study, things that we thought could be grown in the Midwest, specifically in Iowa, both profitably and well, such that they could satisfy demand in the regional economy. And again, that demand is metropolitan demand, not total statewide demand. And so we had this scenario, and we're going to feed a certain number of people in the state of Iowa, and to do this would require 16,215 acres of land. That's how much land would be required to produce $42.4 million worth of vegetable and melon sales. And these are sales at the farm level, not at the farmer's market level. This is sales at the farm gate. And fruits of 19.1 million. So that's going to be based on that bundle of vegetables and fruits that I just showed you. Now, because we're using this land that was used for something else, we have to take that land and that productivity away from grain and soybean or oilseed farming farmers. So we have to take that away. And the amount of output on this number of acres would have been estimated to be 19.8 million. So what we're going to do first is shock the economy by the fruit and vegetable values. And then we're going to offset that with the grain production opportunity costs. So I'm going to enter 42.4 million in the vegetables and melon sector, and I'm going to enter 19.8 million in the ag fruit farming sector, and we're going to look at the results. And we look at the results, and if that kind of production were increased in the state of Iowa, it would stimulate 305 new jobs on the farm. It would stimulate another 261 jobs in the supply sector, and a total effect, broadly, after everything multiplies through, of 566 jobs. But remember, we have to calculate the offset associated with taking this land away from grain farmers and oilseed farmers. So that's what we're going to do in the next exercise. We're going to leave these numbers here. We're going to go right back to here. And what we have to do now is take away 19.8 million. So I'm going to go minus $19.8 million of offsets. And I'm going to take that away from the whole thing so that I'm netting this economic impact out. Now, after accounting for taking this land away from conventional agriculture and converting it to vegetable, melon, and fruit production, we get our net economic impact from this scenario. We had a total of 281 jobs at the farm level, 181 supply sector and or induced jobs, for a total of almost 462 jobs in the state's economy. So it would multiply out to $63.3 million of additional output, $58.1 million of value added, $37.6 million of labor income, to a total of 462 workers. So here's how that we would have calculated that economic impact scenario. Now you would do the same kind of analysis at a small area. If you're adding 50 or 100 acres of production in a region and you want to calculate the economic impact of that new local foods, fruit and vegetable production, again, you have to offset the land, offset the impacts from shifting from one land use to another. Now I've done studies in a state like Iowa where nearly all of the good land is in production. So if you're going to do one thing, you have to not be doing another thing. But there are other states in the United States where there is idle or underused land or abandoned land, and the offsets aren't going to be as high as they would be in a state like Iowa, where land is valuable and land is very widely tilled. Okay, now we're going to turn to the last type of analysis that I'm going to demonstrate. It's called an analysis by parts. It's also called a bill of goods approach. And this approach uses a list of the input costs for production for an outfit or for an organization or for an activity. So what we're going to do is we're going to use several sectors of this model simultaneously. And in this example, we're going to have 14 to work with. And it requires us to piece together the finished output so that it represents the whole of what was measured. And we'll have all of the information to do this. Again, this is a little bit more intricate, but it is a very good way of doing analysis for a sector or a subsector of the economy that isn't a typical sector, or is a sector that's hard for us to characterize given the way the models are currently built. We have then our raw data, and what we have is a food hub, and it's primarily a wholesaler or a distributor of locally produced foods. Now, some of those foods are manufactured foods, and some of those foods are agricultural foods that are sourced from local farmers. But what we're measuring here is the economic value of the food hub. We want to know, what does it contribute to our economy? So we have a breakdown of its total expenses over the course of a year. And so they have to do a lot of delivery, and so they have gasoline costs. And remember, I talked before about margins. Here's my retail margin. Here's my retail margin. And then the rest of the cost of their gasoline goes to the refinery and the distributor. Now, if that's not in the local area, then that's not going to be part of our cost. We're only going to put the margin in. They have real estate costs. They have rent. They have truck lease costs. That's $13,000. They have annual utilities. That's $10,000. Insurance costs of $9,000, so on and so on. Again, we have margin. We have general office supplies that they purchase from a wholesaler. Here's that margin value. And then there's maybe a general office supplies manufacturer in that region where maybe we can assign some of that purchase to that manufacturer. We'll see in a minute. We have banking and credit card fees right here. We have telecommunications fees right here. And then we have payments to workers. The workers in that facility, I have them classified as lower income households, make in all told this much money together. The proprietors of this, whether it's a single person or a partnership, I don't know, has this much money in income, so I've classified them as median income. Now the next step on this is that we have to figure out how much of this was sourced locally. So we know what their expenses were here, but now for an economic impact analysis for my region, I have to know what fraction of these expenses were purchased locally. So they might have purchased 45% of the manufactured goods locally, and 90% of the farm goods, the fresh farm produce goods, locally from the region of analysis. Gasoline retail, you buy that locally. Rent, we're paying it locally. The truck lease is a local renter. The utilities are all being paid locally. Insurance, it's a local insurance agent. General office supplies, yes, the wholesaler I'm saying is local, and that 50% of those paper supplies that they had to buy actually came from a manufacturing plant that's in the region. Usually that's not the case, but for the purposes of this scenario, I put it in there because I can do that. The banking and fees, I'm going to have them banking locally, but that their credit card management system, for example, might be managed externally. So I'm only putting 50% of that in. And telecommunications, we have a combination of landline, which is probably a local carrier, and other maybe a cell phone or other telecommunications costs that are sourced from something external to the regional economy. The workers and the owners of this operation, I'm making them all be within the region. So we have 100%. So now what do we have? We have expenses, and then we have the probability of a local purchase in our model. We do now make decisions as to what goes into the model. Well, initially, remember, this is a wholesaler distributor. It's not doing anything in general to the manufactured goods or in general to the fruits and vegetables other than distributing them. So I don't want them taking credit for the manufactured goods that they convey or for the farm activity that they're able to support. I want the farmers to take credit for that, so we'll do an economic impact analysis for them. That'll be separate. So those values are going to be 0. We're going to multiply this value times the local percent to figure out the values that we're going to put in our model. So every time we have these values, we're going to see which ones we put in our model. And in this case, in the general office supplies, I'm putting in 50%, so it's that much. The telecommunications was 80%, so it's that much. And so now what do we get? We get the amount of information that's entered into the model. We had $800,000 of total expenses. We excluded that $400,000 of the cost of goods sold, and then of that $400,000 in output, we had $374,836 that were going to be based on regional purchases. Now, what I'm going to do is enter all these values into the model and then just show you the results. Okay, so I've entered these values into the model, remembering that we're expressing these amounts in millions, so they're going to be decimal amounts. For example, the retail margin of $2,320 for motor vehicle fuel would be entered in as 0.00232. So we've entered in all of these values into the model, and we can look at the results, but the results are really nonsensical because they're not telling us the full story, because all I've done is put in this analysis by parts, or this bill of goods. I've only entered in the secondary data, the indirect activity and the induced activity. So we're going to go to this tab here that says Food Hub Example, and we're going to piece this all the way together. And so what do we have? Well, we have the information that we already knew. We already knew that our direct output was 400,000, not 800,000, but 400,000 because we excluded the cost of goods sold. So we have the direct value right there for output. We also know that the labor income was 300,000. That's this amount right here. That was 300,000, and all of that was paid to the workers in that regional economy. So there we have that. I've given you additional information that this food hub has 5 jobs. So we have the 5 jobs that are there. So now I've put together the direct data from this project so that we can start building up the full economic impact table. Now we take all of the information that we put in just now in the bill of goods analysis, or the analysis by parts procedure, and we have all of this information right here, and we put that information down here into this category. So we copy it all down into here, and then we sum the direct plus the indirect and induced plus the total, and we get the total economic impact for the region, or the total economic contribution, if that's the way it's going to be measured, of this food hub. Let's say it's a total economic impact because the food hub is new and the production of the local fruits and vegetables as well as the manufactured goods are new, and their production for sale within the region that replaces sales that originally came via import. So we could call this all an economic impact. And in this analysis of by parts example, we've compiled our direct values from the information that we deduced over time. We calculated what our analysis by parts results would be. We've summed those two, and we've got our total economic impact. So in my example then, my food hub contributes $829,000 to the regional economy, $427,000 in labor income to 8.1 total workers. So this is our economic value, economic contribution, and in this case I've said economic impact of my food hub given the scenario that I described. And I have slides that go through exactly what I just said. We need to add these results to the direct values. How to do that is described right here. Then we go to the next slide and we show what I did. We took those indirect and induced amounts and we slid them down into this table so that we can compile our total table. Now we have an assignment. In this assignment, what you're going to do is you're going to calculate, like I did before, the net economic impact of adding 120 acres of fruit and vegetable production to your county. And you're going to assume that those 120 acres must come from existing grain and oilseed cropland. Now you're going to produce 3 tables. You're going to produce a table of the fruit and vegetable production amount. Second, you're going to produce a table of the offsets to conventional farming. And third, you're going to produce a table of the net results. You're going to write at least an additional paragraph or 2 explaining your methods and your findings. So this is going to be your assignment. Now, you're going to use the information that's in this table that I've already used. You're going to have to do some elementary algebra to figure out what your values are going to be for vegetable and melon farming, for fruit farming, and for the reduction in the grain sector. You'll figure out what that is as you think about this a little bit. All the information that you need has been given to you. You're going to use these factors, and then you're going to produce a table, 3 tables, excuse me. You're going to produce 3 tables and a short write-up telling us what you have discovered. Okay, this is the end of the second video. Copies of both of these presentations, Session 1 and Session 2, are in PDF format and can be obtained from the Local Foods website and can be used to follow along with the video portions of this session. Dave's Pretty Good Impact Model for Local Foods can be downloaded from a link on the Local Foods website. Remember, it's an Excel spreadsheet model, and that's what you're going to use when you work with this session. If you have questions or just want to talk about any of this, you're welcome to contact me at Iowa State University. My name is Dave Swenson, and that's my email address there down below.